All right, so now let's take a look at P&E ratio. P&E ratio is something that's kind of important, but at the same time, it's kind of tricky, but a lot of analysts like to look at it. So as you guys can see from your notes, the P&E ratio is the stock price compared to the actual earnings per share. So what it gives you is it gives you a number. And as you can see, what that number is has different sort of implications. So if you're really high or really low, so if it's there's nothing there, or if it's a negative number, then that means that the company is really having a bad financial time. So there's no earnings, or they're losing money, in which case it's probably not a good idea to invest in them. On the other hand, if you have a P&E ratio that is 25 or above, they may have high expected future growth in earnings, or they might actually be having a bad year, or that means that maybe the price of the stock is higher than it should be. And if that's the case, then the stock tends to be overvalued. That means that it's higher than it should be, and it probably will fall when people start selling that stock. Now, if it falls in that 0 to 10 range, then that means the stock is undervalued. So that based on its financial earnings and the information, the stock price should be higher. So a lot of people like to buy stocks when they see P/E ratios that are below 10. Now, a lot of companies fall in between 10 to 17. So this just means that their stock is valued right based on what their performance has been. So a lot of companies you'll see in that 10 to 17 range. Now, when you get to 17 to 25, what's happened is either the stock is slightly overvalued, not too much, but a little bit, or the company's earnings have gotten larger since the last figure was published. So it may actually be growing as well. It's a growth stock which is expected to grow over time, and those earnings are expected to get bigger because of the products that they sell. So P/E ratio is a little tricky and a little involved, but it gives you an idea of whether that stock is overvalued, undervalued, if it's at the right value, and if you should be able to grow, it should grow or not. Obviously, you have to look at what products this company makes if you're expecting growth in the future, but this is probably a good way to at least have an idea of what's happening with that stock price.